Good morning, everyone, and thank you for joining this month's Reach Your Potential webinar series. My name is Bindiya Patel, and I'm the Product Development and Strategy Manager at Envisant. Today's presentation is by McQueen Financial Advisors. McQueen Financial Advisors was established by Charlie McQueen in 1999 to offer specialized investment and consulting services to financial institutions. Charlie is responsible for overseeing the core services of investment portfolio management, asset liability management, and valuation and advisory services at McQueen Financial Advisors. Charlie is a well-known speaker at financial institutions, conferences, where he provides education and training on a variety of topics. He graduated from Western Michigan University with a BBA in management. Before we get started, I just wanted to give a couple reminders. This webinar is being recorded and the recording will be shared with everyone after the call. If you have any questions during the presentation, please feel free to use the Q&A option or the chat option, and we'll try to answer all the questions as we are going through the presentation. Otherwise, we'll try to answer them at the end of the presentation. So without further ado, I'll pass it on to Charlie. Charlie, take it away.
Thank you very much. I appreciate the information and the going through the list of stuff there. It's way too long of an introduction. I love it though, but thank you very much, Belinda. I really appreciate it. Welcome everyone. Thank you for joining us. Thank you for taking some time out of your day and a wonderful good morning. It is winter here. I'm coming for you from Detroit, Michigan. 20 degrees this morning. So if I start shivering, it's because I'm our office, which is it's actually kind of a neat thing. I'm working out of our office, but our office, which is cement walls and cement floors, is definitely not staying warm today. But again, thank you for joining us. Please, any questions, throw in the Q&A function. We'll answer them along the way. One of the things I do appreciate, and I'll skip through the information here, but where the information comes from here to share is we do have three main groups in our team. We have our investment advisory team, which manages bond portfolios. They manage over $16 billion of the bond portfolios. We have our asset liability management team, which does ALM reporting for credit unions actually in every state of the country. And then our valuation and transaction advisory group, which coined the activity of credit unions buying banks. So some neat stuff. We do a lot of merger valuations and in the credit union space. So thank you for having me today. Today is something I'm very passionate about, talking about what's coming up in 2024 and budgeting and planning. A lot of questions going on with this different interest rate environment we're in, with a lot of conversations happening about overdraft protection costs and revenues going away, all sorts of different things going out there. But it is going to be an interesting year where we are with interest rates, deposits, and making sure you're well prepared for 2024 is going to be something extremely important. So with that, we'll kick stuff off. And, it'd be sad not to start with this, but it's really important here is inflation is the biggest thing we're facing today. We had some little stronger economic data came out today actually than what we want, but this has been the problem that's been bothering everyone. Interest rates are important, absolutely, but inflation and how inflation hits us is extremely important. And so looking what's happened, we're back here in 2004 on the far left side of your screen. We have three different lines. The black dotted line is the total consumer price index. The blue line is ex food and energy at 4%. And the red line is the personal consumption expenditure core index. That's the one that really the regulators in the world worries about. If you want an idea of what's going to happen, if the Fed's going to keep rates the same or lower them or increase them, pay attention to the personal consumption expenditure core index. That continues to come down. The Fed's not going to raise rates. If it continues to come down and really gets close to 3, we might even see the Fed start to think about lowering rates. But we can see here rates, inflation rates have been really close to 2% for a long time now until the spike up here. We got really high with overall close to 9%, down back into close to 3%. So we are seeing inflation continue to go up, but at a slower pace. And if we look at inflation in a shorter term, and this graph here just looks at PCE, the one I just talked about, and core CPI, but this is starting through 2019, 2021, 2022, and into 2023. We peaked out with inflation at the end of 2022, September of 2022, and we've continued to go down. Most recently, we're coming down at a little faster pace is what it's showing here, this purple color. The green color is where we were before. It was coming down, but still at a slower pace. So what we're seeing now is that inflation is coming down at a faster pace. So prices are going up, but they're going up at a slower pace is a way to look at it. We're not out of the problems yet. The Fed really is going to continue to keep interest rates high until we approach 2%. And so that's going to be the big thing, and why we always talk about the Fed being data dependent. Things are going in the right direction, but if inflation would turn and start to come back up, that would cause the Fed to either pause longer or potentially raise rates. But inflation continues on the path it is now. We expect the Fed to continue to pause, and we'll show you our projections in a few slides, and eventually start to lower rates. So very, very data dependent. One of the unique things here is if we look at what's going on, you think about it in each of your credit unions, the unemployment rate is extremely low. And now you have to remember the Fed has a dual mandate, price stability and full employment, where they're definitely achieving full employment. We have no unemployment, or very, very low unemployment, but we're not achieving price stability. And so what ends up happening, why they raise rates, is to slow the economy. And that's the hammer they have. And so they're using that to raising the Fed funds rate, which then, raising up all of the rates. What ends up happening is it should cause unemployment, which then causes people to buy less things, which then reduces inflation. So we're seeing that. We're seeing things more expensive right now, houses more expensive, cars more expensive, a lot of things. And a lot of it's also based off of interest rates and where loan rates are. But what we're seeing here is we are still at an unbelievably low level of unemployment. National unemployment 3.9. We continue to be very low. So we're probably going to see this start to tick up a little bit. And the reason why the Fed needs that to happen again is to get rid of this inflation issue so they can both have price stability and full employment. So there's always a little bit of a trade-off. Now, one of the things as we think about budgeting for next year, we've had this thing we call the yield curve. And this was a normal sloped yield curve, 3 months here, going all the way out to 10 years. The red dotted line is where we are today. It's almost a yield line, we can call it. It was inverted, but still is technically inverted. Short-term yields up here. If we look here, this is just a few days ago, November 20th, 539 in the short end. Then we get out here to the long end, the 10 years of 447. So definitely an inverted yield curve. What this tells us is that the market believes that by the Fed raising the short-term rate, the Fed funds rate, that they are going to slow the economy enough that we don't need to have long interest rates for a long period of time because they're going to break inflation. And so you can actually, it's okay to take a lower yield for a longer period of time because the Fed will break inflation and this yield curve will start to look more like a 45 or 30 degree angle again, where long-term yields are higher than short-term yields. So that's where the Fed's going. The big question is, do we have a soft landing or do we have a hard landing? Historically, the Fed has not been able to engineer a soft landing. I love this chart, one of my favorites, those of you that don't know me. It's a picture of the yield curve, but in a different way. What we're looking at here are three things: the Fed funds rate, the red line, the 10-year Treasury, the black dotted line, and the 2-year Treasury, the blue line. And we've graphed them over a period of time, going from 2005 all the way to today. So if we look back, here's the financial crisis, the housing bubble, whatever we want to call it. The Fed was raising rates in 2005 and 2006 for the purpose of breaking the housing market. The housing was overvalued. People were getting crazy. So what ended up happening here is you see we get to a spot where we have a flat yield curve where the 10-year Treasury, the 2-year Treasury, and the Fed funds rate all equal the same. The Fed then paused as the world then really took these higher rates and it started to cause the housing market to break. And then once the housing market broke, the Fed quickly dropped the Fed funds rate. And what ended up happening is the 2-year Treasury came crashing down with it, where we came all the way down to 25 basis points in 2009. The 10-year Treasury stayed here, it didn't quite know what to do, and it slowly came down. So this is a normal cycle the Fed has done over and over again. And here in 2018, 19, 20, we were raising rates because actually the economy was starting to do pretty well. And then we had a little pandemic here. Another interesting thing here is why the 10-year Treasury gets so low here, where Charlie got his 2.75% 30-year fixed rate mortgage. That was quantitative easing. The Fed was actively buying treasuries, buying mortgage-backed securities, buying everything to stimulate the economy. And so when they did that, that gave us the unbelievably low yields. But then once that was over, inflation was really kicking in, rates skyrocketed. So here we are today. We're in this pause mode right by my red pointer there, which we believe is the beginning of over here in 2006, 2007, where the Fed should keep unchanged for a period of time. And then we have the economy start to slow down. Again, is it a slowdown or a recession? That's going to be the tough one. It's a recession if someone else loses, or it's a recession if I lose my job. It's a slowdown if someone else loses their job. A lot of it's perception. We'll definitely see what happens here, but a lot is going to be known in the next couple months. And a lot of it here has to do, you think about what's happening in home prices. Home prices, this is back in 2005, 6, and we had our overvalued home prices here. We all thought they were through the roof. And as we go farther out, they've continued to skyrocket. Home prices are substantially much higher, which makes it very difficult because we have higher home prices and we have much higher mortgage rates. So homes have become extremely unaffordable, much more so back than we were in 2004, 5, 6. A lot of demand, not a lot of supply. We haven't built a lot of homes. So definitely some interesting issues. The stock market's also telling us we're at a point of inflection. It's up a little bit since this picture was taken a few days ago. But once we had the pandemic hit, then we had all the day traders hanging out at home. But the last couple of years now, we've been flat to down. And so this is the S&P 500. So a lot of the charts are telling us that we're at this point of inflection where the Fed, will they be successful in engineering their first ever soft landing, or will it be a difficult landing? Well, right now, the Fed funds futures, which is the betting in the Fed funds market. This isn't our predictions, although I do agree with them, but this is the betting in the Fed funds market, is that the Fed funds rate, looking at the dates here, which is currently 550 is the upper end of the Fed funds rate. Here's December, that it is going to remain unchanged. Now, this chart, the minute the picture was taken, said May of 24, it goes down 25 basis points. Last time I ran this chart before this, it was July of 24, we'd go down 25 basis points. But here, this has us by the end of 2024, that we're all the way down to 4.5% on the Fed funds rate, or 100 basis point reduction. Now, the Fed funds futures are a good thing to look at. They're never perfect. They're never right. But I do think what we can take from this is that the Fed is more likely in the third or fourth quarter of next year going to be lowering interest rates because something in the economy is broken. Now, what would make the betting in the marketplace be wrong? If we get some strong economic data, we get some strong employment data, we get some higher inflation than expected. That then would change this where the rates would stay higher for even longer. So the direction is right. We are seeing a lot of things that are predicting a bit of a slowdown next year. And one of those things that is predicting a slowdown is the ISM Manufacturing Index. And what this is anything below 50 is considered that we're in a contraction. And so we have been in a contraction in manufacturing pretty much for all of 2022. And it's not just the US, it's also Eurozone, Europe, and Japan and Asia. There is a manufacturing contraction that is taking place right now. So we think that we're in some sort of slowdown. We don't know how big of a slowdown. And remember, recessions are always called after we enter recession. It's a hindsight type activity. So as we think forward, where do we think rates are going to go? Well, we do think the Fed is going to reduce rates somewhere around June, July, August of next year. We expect a gradual slowdown. We don't expect them to drop rates dramatically. If they would drop rates dramatically, that would be that then there's a hard landing, that there's a problem. The biggest concern everyone has is commercial real estate. We're definitely seeing a lot of problems in commercial real estate with valuations and utilization of office buildings specifically. A lot of large cities are struggling with this versus smaller towns, so it's never equal. That's perceived as the most likely the problem out there. Not as much of a concern in housing as we think about what's happening with housing. Such demand, people want to move, but it's so hard to move where mortgage rates are and home values are. We also have not built enough homes. So I'm not as worried about home values, but I do think they are lofty and they can come down a little bit. I don't see anything like the financial crisis. I am, though, more worried about commercial office real estate, as office utilization is low compared to where it's been historically. The rest of the rates here, again, we see things starting to slow down a little bit in June of 24. A lot of this is going to be GDP and what happens, and CPI, what happens. But we have CPI heading down towards 2% by September of 2024. So what this does is this puts an interesting spot for all of us, and it'll be neat to see where we go. But planning for next year and budgeting for next year, this is tough. It's a tough spot with deposits. And, I think that one of the things we need to make sure is that we think carefully about how we're going to project growth. Now, the foreshadow here, I expect deposits to be extremely difficult to generate in 2024. CUNA is saying that they expect a 3 to 4% or 2 to 3% growth of deposits. We're predicting between -4 and -9% for deposit growth for the industry this next 12 months for 2024. Well, why is that? Well, one, we went through this interesting thing. This is money supply, M2. This is what the pandemic did and the crazy spending that happened at a federal level. And by the way, I don't like any politicians. I make fun of both Democrats and Republicans. I dislike all politicians, basically. But what this tells us here is they went on a spending spree and spent way too much money. So what ended up happening? We had 5 years of money supply growth in a couple quarters. It's coming back down. We're doing the Fed is now doing quantitative tightening, which is pulling money out of the system. Along with that, with inflation, making it harder for people to save, what we've seen here is this is the quarterly change in deposits at banks. Now, this is FDIC data, and I did that on purpose because the FDIC, the number of banks, the size of banks, JP Morgan is as big as almost the entire credit union industry. It's imperative to look at this from a data standpoint. But what we see here is we have a constant growth, constant little growth, couple quarters slightly down, couple quarters up a little bit, but it's been that way for a long time. And then here you go is the pandemic. These are the pandemic funds that came pouring in. And now we have the pandemic funds pouring out. We're at 5 quarters of negative deposit growth at the entire banking system. Some of this is going to the federal government. Some of this is going to money market accounts. Some of it is just disappearing. But this is making it extremely difficult for us to grow deposits. Now, if we look here, this is bank data also, and it's broken into assets greater than $1 billion and assets less than $1 billion. Really, really important because, again, the size of the market's important, and a lot of our competition comes this way. What's happening? Well, the large banks are raising their deposit costs, and this is the quarterly cost of funding, the deposit costs. They're raising it very, very quickly to attract deposits, and we're seeing average cost of funds over 2% at large banks. And smaller community banks, much more like credit unions here, we're around 1.25 to 170, 150. So we're seeing this cost of funds scale up very quickly. And this is normal where the larger banks are going to push really hard to get deposits fast and quicker because they also want to turn their assets over. So if you think about this, we're in this environment, cost of funds is going to be going up very quickly. If we like it or not, we can delay it a little bit. We can delay it for a while by not increasing our rates, but then we're going to have some trouble getting rates, but eventually we're going to have our deposit costs come up. One of the most important things to do is to keep lending. We think about here in ALM and your overall balance sheet management, as we go into 2024, it's really, really important that we get in and we keep adding loans to the books. Why is that? Well, if we don't turn our loan book over, we don't turn our loans over, our cost of funds goes up and our margin gets squeezed. And so we need to work at it and continue to grow loans. It's going to be extremely difficult, especially if we're shrinking deposits. But working with Envisant, working with Nickel and different things to really come up with ways to help grow deposits is really, really, or grow loans is really, really important. Even if we change the balance sheet around where the overall balance sheet size isn't changing, we really want to make sure that we're getting new loans in the books and we're continuing to turn it over. Car loans today are 8% range. And if we look at this here, again, bank data again, because of the size, quarterly yield on earning assets, larger banks are now up to about a 5.5% yield on assets. Smaller banks are around 5%. What we need to do is continue to put these 8 and 9% car loans on the books and really do our best to get loans on the books so we continue to turn over our overall yield on assets so we can continue to have a strong margin with our cost of funds coming up pretty quickly. Really, really important. One of the big things to take away from this is making sure that you don't stop lending. You obviously have to manage liquidity and manage your balance sheet correctly, but we want to keep turning our assets over to make sure our margin is good and we continue to do well into next year. Now, it's easy for me to say, hey, grow loans, really hard to implement today. We're definitely seeing here, and this is total loans, they have flattened out, and we're seeing a definitely flattening of lending. People are reducing their borrowing needs. We're actually seeing borrowing needs change quite a bit, which we'll talk about. But it is going to be difficult to get loans in the books. Now, especially if you were used to doing in the mortgage world. It's a shocker here, and I laugh. Here in Detroit, 30% of all mortgages 2 years ago in this country were done in Detroit between United Wholesale Mortgage and Quicken Loans. That's when we were up here. Ridiculous amount of loans being written every day, and now we're down here. Mortgage world, you're getting a loan written if someone is in dire financial needs, or if they have a divorce, or they move to another city, a death. Very, very infrequently we're going to see anyone refinance, given how much higher interest rates are. Someone gave me a note the other day that said all mortgages in the country, or 30% of all mortgages in the United States, are below 3.5% yield. I haven't had a chance to validate that, but that just would give you an idea of the lack of refinancing that we're going to see. But along with the lack of refinancing, we're seeing people change their borrowing habits. If you think back, historically, I would have said, hey, I want to go to my credit union. What am I going to get? I'm going to get a mortgage loan and a car loan. Those are the two important things that we would focus on. Well, what we're seeing happen is we've definitely seen the mortgage world change dramatically. If we look down here, we have junior lien, first lien. What we're seeing here is that mortgages, the growth of mortgages is declining, but junior liens, home equity lines of credit, these are really starting to pop up. Well, that makes sense to me. If I'm not going to buy a new house because I don't want to get rid of my 2.75% 30-year fixed rate mortgage, I'm going to do a remodel and I have to borrow money of some sorts. And so we're seeing those junior liens pop in. Everything we're seeing is substantial increase of credit card balances and payday alternative lending. So we're seeing this happen. We're talking a lot about buy now, pay later things on stores and how people are using that versus payday alternative lending. But at the same point, credit card loans are up, and actually outstanding credit card balances are up substantially. Great chart in the Wall Street Journal the other day, which showed the outstanding balances of credit cards, and the largest group, or the top of the range they do is 100,000 plus income. People with income of $100,000 plus was the highest breakout they had, and they were close to 60% utilization of their lines of credit, which I thought was just an incredibly high number. So definitely people are trading what they're doing. We do see here we got some big increases of vehicle lending after some decreases that took place. Vehicle lending is an interesting spot, and auto lending is an interesting spot. We have seen the price of used cars skyrocket, and now we're coming down pretty darn quickly. Well, they skyrocketed because of supply and demand. Cars were not being produced with COVID. If you go back before that, there was other slowdowns in the automotive space and bankruptcies years before that. So the pool of used cars got much smaller. Well, now production's back to full speed. We're working through those inventory low periods. We're beginning to see these really high numbers come down. Now we're as high as about 260 on the index, and now we're down to 200. So a fairly substantial reduction in used car prices. So just make sure that you're being careful with your used car pricing and making sure you have good liquidity in there. We're also seeing a lot of people realize that indirect car lending is a bit crazy competitive wise. We've had some clients say to us, hey, we don't understand, we're getting a 6% yield post our dealer reserves and other fees. I can go buy loans at an 8.5% yield. So definitely an interesting spot today. We're looking at yields and making sure that we're thinking about this when we're putting loans in the books. One of the things to add with this, really important to me, is making sure we're thinking about loan pricing. Things got really slow with loan pricing. We weren't changing prices that often, but a lot has changed, and a lot has changed very quickly. Here's an example. Put the risk-free U.S. Treasury rate at 5.5%. We decided, hey, CECL, 50 basis points. And one of the things to remember is CECL is a forward-looking number. And today there's an announcement by the major car lending institutions that we are now at a 5-year high. We're seeing a substantial increase in delinquency in car lending right now. So CECL allowance is always going to be forward-looking, so we're probably going to see that go up from here. But we'll say it's 50 basis points just for an argumentative spot, 50 basis points for servicing. And then, I want an ROA of at least 1% because this is incremental lending. I would believe if we're adding a loan, it's an incremental lending. I want at least 1%, if not more. So this would be the absolute bottom. That means to me that the minimum pricing in this example should be 7.5%. Those of you that are clients of ours, I'm really excited. We actually have an interactive loan pricing module that's popping up on our web app here, the MFA Navigator, in the next week. So I'm really excited about that. But something to think about. I want everyone to make sure that you're pricing your loans correctly, as you're going to need to get the higher yields on the books because we're going to get the higher cost of funds come flying in pretty quickly. All right. Hopping over from there to a little bit of non-interest income discussion. ALM is so important thinking about that. But some of the issues that we're seeing today is that we're getting a lot of threats. And, we're getting a lot of threats that we're probably going to see some of our overdraft protection get hit, our fees get hit. It drives me crazy that that's what our regulators are looking at today when the buy now, pay laters out there is exploding. And the interest rates on those are huge, and that where the fees are being paid from the manufacturer of the good or the seller of the good. A lot of those are hidden things that aren't out there. So while people are using payday lending more, buy now, pay later options more, it's hard to see that we're getting hit for overdraft protection, which is being much more useful in my opinion. But I do encourage everyone to talk about this, write your regulators, write your congressman about how silly it is to go down this path right now. So something to think about. I do think it's imperative we work through this and spend some time on this. But there's a lot of different things we can get into. So if we think about this today, I was on a call the other day where a client is thinking about getting into doing crypto and selling cryptocurrency to their members. And my thought was, gosh, I like the theory of selling cryptocurrency to our members, but maybe we should do the basics first. Why don't we have a brokerage relationship where we have a broker in the lobby and we help people with their rollover 401ks, IRAs, standard brokerage work. That's something we could work on. Another thing that I think is really good is a similar thing that members do need is insurance. The insurance market is changing dramatically. A number of good friends of mine in the insurance business had some very kind of scary conversations about the cost of fixing cars right now. And we're going to see insurance costs rise dramatically because the cost of car parts, the cost of people doing the work on cars is skyrocketing quite a bit. So something to think about here. Other things that I like, obviously, are debit cards, credit cards to get our income, to get our all the income we possibly can get there, interchange income. Mortgage is going to be dead. We still need to do it because someone is going to buy a house, but we want to do that. And if we keep the loan in our books or we sell, that's a personal decision based off of your interest rate risk position. But the one thing I did miss here and purpose to talk about in the end is SBA. SBA lending, Small Business Administration, can be a great thing today that you can use where if you have a credit that you may not love, but you still think it's a good credit, you do have the capacity to use SBA lending to put those credits on your books and remove the risk from your books and take a fee income. So SBA lending is an interesting spot to think about. More and more institutions are reaching out to us talking about SBA lending as a way to continue to lend, maybe to some people we're nervous about, but still are, still good credits. Neat spot. But as we think through, one of the things I want to make sure, if we think about what happens in an interest rate cycle, when interest rates go up, mortgage lending goes down. When interest rates go down, mortgage lending goes up based off of refinancing. And so I do want to be in the mortgage business. I do want to have mortgage relationships and either have the capacity to do all the mortgages I want in-house or with a partner. Either way is good. because some point interest rates will come down and that will be a good business. At the same point, some of these other businesses do good in all economic environments. Insurance is something hard to get into, but over long term, it pays off. Having a broker in the lobby, it's difficult to make money in the business, but it does well in both a rising and falling interest rate environment. So it's important to spend some time on this, especially for budgeting for next year, and think about what we can do to help protect us if we do see all the cuts in ODP and debit card, credit card interchange income. So shifting gears a little bit, thinking about the investment portfolio and where we are with the investment portfolio today and where we are with interest rates, we're going to enter a different environment now, which means we need to do a little bit of different thinking on investing. So this is just an amazing slide to me. Thinking about where we were at the 10-year Treasury, going back to 2019 all the way through today, we hit this really low spot of 50 basis points. And this was all the quantitative easing that the Fed was doing by buying securities and driving yields down. But then we've had this astronomical rise all the way up to 5%. We've dropped down a little bit from there, but an unbelievable increase of 4.5% in a couple of years. Just amazing. And this is where ALM models, get in trouble and start to be stressed. But rates have come up dramatically because the Fed has raised rates dramatically, and we've entered into a much higher inflationary environment. Could this be the turning point? It could be. Could this be where rates come down? Could it be where they go flat? We think probably flat for a bit, and if inflation is knocked down, it then can come back down. Now, one of the things in thinking about investing is, where do we take risk? Well, one of the things we like to keep a close eye on are credit default swaps. Not that we need to buy credit default swaps or it's appropriate for anyone on this call, but we like to look at and see where we are with in generic credit default swaps. So here, what this is showing how much credit default swaps spiked when we entered into the pandemic. And what this is, a credit default swap is saying, I want to buy insurance to insure myself against a credit failing. I don't want to take a loss. And you can buy insurance. And insurance gets as low as 40 and as high as 160 here. We've definitely been high. We've been coming down. We have these spikes. We're at a relatively low level now because of a lot of people think there's a potential for a soft landing. But anytime we see credit default swaps get up into kind of this high range, here, we end up in some sort of downturn or recession. So we want to be very cautious. And I think my point that I really want to make here is, as you're looking at investments, be very careful with credit today. We're at a spot where credit is more likely to come down than go up or improve. One of the things we do like is municipal credits. Municipal credit has done very well across the country. A lot of municipalities got lots of money from the federal government, part of the stimulus activities with COVID. A lot of them have redone debt, reduced debt. They've taken care of pension liabilities, but there's also some bad ones out there. There's a lot of municipalities that are really, really struggling that I wouldn't want to, put money in. Corporate bonds, I really want to be careful today, just not understanding how much the higher interest rate environment is going to hurt a lot of corporate bonds. As we think, though, about investments besides credit, one of the big things is structure. Our investment advisory team, incredible people that work here, really proud of all of them, really working hard with all of our clients to remove negative convexity, if they had any, and definitely not put any negative convexity on their books. What is negative convexity? Well, it does the exact wrong thing. So what that means is, interest rates rise, the duration of that investment gets longer, which is not what I want. Interest rates come down, the duration of that investment gets shorter. That's not what I want. I want something, while interest rates rise, I don't want my duration to extend at all, because I want to then buy something new at a higher rate and keep it out there for longer. So as you're buying securities today, I would avoid mortgage-backed securities. I would avoid callable securities. I'd avoid anything with a step up. It doesn't matter if people tell you it's an out-of-the-money call or out-of-the-money step. Non-callable securities are going to be the best thing to buy for a little longer duration on average. Take advantage of these higher yields today. It's a really, really good spot for us to add yield to our books. And again, think about this. We want to turn over that yield. So as we're in 2024, we're booking higher yields. We have a higher income stream to cover that higher cost of funds. And also, one of the things that does concern me is, if we do enter a recession or some sort of slowdown here, but we're going to see higher CECL reserves necessary and higher credit losses. So I also want to make sure that I'm boosting my earnings as much as possible so I can pay for that higher credit costs. So focusing this year, it's a great way of thinking about, really focusing on this year is how can we really focus on profitability? How can we focus on structure and not necessarily growth? Something really important to think about. How do we focus on structure and process and getting our loan yields overall higher, but not worry about growing significant amounts? So the investment portfolio, a lot of things can be done. Swaps, great day today to think about that. A lot of our clients will look and say, hey, it's been a really good year. Let's take and sell some securities before year end and maybe get to a normalized earning level for this year. And we're really going to boost earnings for next year and start off on January 1 with a much higher yield on a number of investments. Other things to do is on January 1, we do a lot of transactions, not technically January 1st, but the first week of January, where we're going to sell a lot of securities. Because then it gives us the entire 12 months of the year to make up losses, and we're in a much better spot on going forward. One of the things that selling is not always thought about carefully. When selling a security, you need to think about it the same way as buying a security. What I mean with that is you need to get multiple bids. You need to get at least 3 bids when selling a security like you do with buying a security. One of the things we find is when selling securities, brokerage firms realize you're usually not going to anyone else, and they tend to not give you the best prices. So something to think carefully about. If you have ever questions, you can talk to any of our people on our team that can give it examples and help, but make sure you're being careful when doing selling. So with that, I want to hop over and talk a little bit about what's going on in the merger space and the transaction advisory space, and what can you expect to see in 2024. It'll be interesting. 2024, I expect to be a pretty darn slow year for transaction advisory. This is looking back at credit unions, liquidations, mergers, and purchases, some weird stuff that's taken place. Our numbers are getting really, really low. We're half of where we've been pretty much any quarter. Why is that? Well, we have to remember the mark-to-market side of things. When we do purchase accounting and the credit unions merging, one balance sheet has to be mark-to-market. The problem that we're seeing, we all know about the investment portfolios and how the investment portfolios are underwater. But when you get to loan portfolios, especially credit unions that booked a lot of 30-year fixed-rate mortgages, definitely a difficult time. Those mortgages all get marked to market. Now, your go-forward earnings look great when you take a whole bunch of 4% mortgages and mark them to market to 7.5%, but that hit to capital at time of merger is substantial. And so after all the years of growth, then take a hit on capital is a very difficult spot. So we do expect it to stay slow in the merger space for the next couple of years because of the valuation. Time will heal a lot of this. Time will heal it because what ends up happening is the problems slowly go away because as time goes by, we keep resetting at higher interest rates and we get closer to maturity dates, so valuations improve. Now, the bank purchase space in the credit union, this is a U.S. credit unions acquiring banks from S&P Global, their data here, hit record numbers here in 2022. We had things slow down because of the pandemic and come back to record levels, and we've slowed down again. The reason being here for 2023 is really going back to, and this is as of August, so it'll bump up a bit more before year end, but the valuation aspect of mergers hurts purchases also. So definitely difficult. So I expect to see a lot less activities from bank purchases. We'll still see some, don't get me wrong, and there'll be a number more announced this year, but it's going to see things slow down a bit because of the valuation aspect. What we're not seeing slow down here is closing of branches. Now, this is just a funny graph here, but I thought it was neat because Illinois was on the top. There were 5 net openings and closings. There were 6 openings in the state of Illinois of bank and credit union branches, and then 1 closing. What was interesting here as I was getting ready for this meeting and thinking about our presentation this last week, on Monday, there was an announcement that over 66 bank branches were announced closed just Monday of this week alone. We are seeing branches being closed at a very, very fast rate from banks. We're seeing some from credit unions, not nearly as much, but the reason that we're seeing them close is for profitability purposes. We saw the bank's cost of funds skyrocketing. Well, there's then a couple other levers. Well, you can continue to increase your yield on assets, and they're trying very hard to do that. But the other thing you can do to combat expenses is to reduce the number of branches. So one of the things I want to challenge everyone here is think about, for your plan next year, think about, are there branches you should close? Are there branches you should consolidate? Are there branches you should move? We're definitely seeing modifications on how people utilize our financial institution, how they use our credit union. My favorite branch I call the Charlie branch is when I pick up my phone and take a picture of a check that gets sent to me, and I don't have to leave my desk. Or I do a bill pay. A bill comes in, I open up the app and do a bill pay and close the app and move on. We're all interacting differently with our credit unions, and so it's important that we think about branching strategy very carefully. So as we roll into strategic planning, one of the things that can easily get overlooked, because sometimes strategic planning becomes just a process and everyone hops on that process and just runs with it. But make sure that you're putting together a real strategic plan. What are we going to do differently in 2024 that we've not done in the past? Let's make sure that we have clearly defined goals. Remember, whatever you put as a goal, you will work to achieve. So clearly defining your goals and measuring your goals is going to be really important. And then also work on how to achieve. And we follow a path where we come up with annual goals, and we do then quarterly goals, and then we do weekly goals. So we know every week we're working towards our quarterly goals. If we achieve our quarterly goals, we'll get our annual goals. So breaking things down into levels that are really important. So thinking of this, I know it's strategic planning time of the year, and I know we're all planning for next year and budgeting. I wanted to give everyone here on the call a couple, things to think about, and I have 6 take-home discussion points, and just to work through and take these and think about for your financial success. So really, really important things to think about and to plan for. So, 2024, we're going to hear a lot of comments about maybe the Fed raises rates, maybe the Fed lower rates, maybe they stay higher for longer. Our expectation is that the Fed is going to be on hold. We don't think they're going to cut rates as quickly or as soon as many do, but we think third, fourth quarter next year. What you should be prepared for is really the tougher outcome. The tougher outcome is that rates stay higher for longer and our cost of funds continues to go up. We want to be prepared for that. We also want to be okay if rates come down. That's fine, and that'd be good because that'll help us reduce our cost of funds and reduce borrowing costs. But we want to be prepared for the Fed staying higher for a little bit longer, because that's going to be the toughest thing for us. So with that, what do we need to do? So number one, again, be prepared, even though we're going to hear all sorts of different economic viewpoints, but be prepared effectively for the worst. Point 2 is really be ready to fight for deposits and have your unique message, your unique story. Be out there, be asking for deposits, be proactive. Look at your balances, look to see if we're seeing runoff in areas and modifying rates. I'm going to say flat to -5% here. Earlier I said -4 to -9%. What I can tell you for certain is it is going to be a very, very difficult time to get deposits. And we do think that it's going to continue to be that way. And again, you got to think about affordability. Inflation's been so high, people are saving less. Also, money market yields are extremely high. You look at the 5.20, 5.15 yielding money markets out there at Goldman Sachs and different institutions. It's going to be tough as we see money moved out of the credit union space into more of a brokerage space. We're going to see CDs grow. People understand the value of CDs again. They're now back in the market. So it's a good spot to look at that and make sure that your CD offering is robust. Make sure you're trying not to do too much disintermediation and move money market accounts to CDs or savings or checking or share accounts to CDs, because that'll definitely hurt our profitability. Borrowings, it continues to grow, and that's okay. We think about this, if we're growing our assets today, which I like growing our assets because those yields, those 8-9% yields, especially if we're doing 8-9% yields. I don't like growing assets at 6% yields. But if I'm growing 8 or 9% yields and I'm borrowing at 5.5%, that's not a bad spot. That's actually a really good spread. That's better than my 7.5% I showed in those examples. So with this, plan for more stress, plan for things to be more difficult. Think about what makes you unique, what gets people to show up at your shop and bring deposits to you. And again, make sure a liquidity standpoint, Liquidity is going to be one of the major exam issues out there. Make sure that you have good lines of credit. You have multiple lines of credit. Your ways that you can ensure that your members are going to be well taken care of with you having really big lines of credit. So something to work on. Getting to point number 3. It is going to be difficult to get loans in the books. I 100% get that. I want to be careful that we're only putting good yielding loans in the books, but I also want to make sure we're doing quality. It's going to make it very difficult to grow loans. I know I've said I want them to grow. It's really easy for me to say grow loans. It's very difficult to get it done. We're seeing people early working on working with their lending teams, buying loans, doing all sorts of different things to try to keep lending going, but also understanding members' needs are changing. ARMs, balloons, lines of credit are all replacing standard mortgage activities of the past few years. So make sure your products are looking good. I do worry about loan delinquency coming up here. So I just want to reiterate that I want to make sure that I'm thinking about quality. Mentioned SBA credits earlier today. I think I've covered that. But I think that mortgage creativity is going to come into play. And one of the things that I find entertaining is when I look at people's loan rates, I see that a 30-year fixed rate mortgage is 7.5% and a 5/1 ARM is 7.5% also. I think we really want to make sure we're thinking about how we price our loans. And this is where we can be a little bit creative to maybe get some lending on a shorter term basis that we may not get by playing with some of our shorter ARM type mortgage loan rates and balloon mortgage loan rates. All right, point number 4. Oh, and just before I forget, don't forget home equities. We're definitely going to see people making modifications to their homes since they're not going to be able to sell because they can't afford a new mortgage. We're going to continue to see that area grow. So point 4, proper investment management. I think really, really important when we think about this, that we're managing our portfolio with little to no optionality going forward, that we're probably extending the duration a little bit. Have to look at each of your individual ALM reports, but making sure that duration is understood in what we're trying to do. Not just buying the bond of the day or the wonderful thing, but buying what you need and making sure that we're filling in a portfolio that's going to provide us with earnings for a long period of time. I am a big fan of loss sales and swaps and doing all sorts of stuff right now. Really a great time to do this. But again, make sure you're being thoughtful in what you're buying. Credit is going to be an issue if we go into a downturn. We want to make sure we're not taking on any goofy credits. So another thing that's actually interesting here with point 4, a lot of people have been getting into employee benefit pre-funding accounts and charitable donation accounts. That's a great way to enhance your yield and then to use those dollars either to give away in charitable ways or to help pay for 401k plans. Something that we're really excited and been spending a lot of time with our clients on is building these up, because as we look at our profitability, and my point 5 is really understanding margin. Margin and profitability come together to me because we're in a margin business. But if I can increase my margin by increasing my asset yield, by using a EBPA employee benefit pre-funding account to cover my employee expenses, that's a great way to boost my overall earnings and continue to improve my margin. We are in a margin business, obviously, that's moving very quickly. As rates go up, we want to get that balance in place. We really want to be thoughtful about that. That liability cost, we want to keep it as low as possible, but we know it's got to come up to make things work. So a lot of effort's going to have to go in there. Really good loan yields, making good decisions, and working on that cost of funds is going to be key. Point 6, again, merger volumes are going to be down. Valuations are extremely difficult. We want to make sure that we're maximizing earnings, because if you think about this, what really matters, why are members happy? Well, you have good capital, you have a good plan, you have a good structure of people in place. You can remain independent forever and be able to grow and go down the path you want and not have to worry about merging someone else in. That's why strategic planning is even more important this year, because it's going to be difficult to grow, and it's actually a really good message to give to your board of directors. I would expect a lot of boards of directors are very much set on, hey, we need to grow 5, 6, 7% a year, because that's what we've always done, or over the last 5 years. Now it's time to say to the board, look, we're probably going to shrink 4 or 5% this year, which is okay. And what we're going to do is focus on profitability, focus on process, focus on ensuring our branch structure is correct and making sure we're all in a good spot. So with that, I really appreciate the time with everyone today. I think this is one of those options where we have in one of those points in life where we're going to see people that plan really well and are ready to make good decisions are going to come out of this economic environment substantially better than others that just kind of make adjustments as they go. So I highly encourage all of you in planning to think about rates remaining high, to think about, you know, what can we do to grow deposits in any way, but be prepared to accept lack of growth and really focus on earnings. Blocking and tackling is going to be one of the key things that we need to do in 2024. So with that, I appreciate everyone's time. If anyone has any comments or questions, please feel free to throw it into the chat box or the Q&A box here, and we'll hit through them.
Thank you, Charlie. Thank you so much. This was very, very informational. I don't see any questions coming in, but like I said before, we will be sharing this webinar with everyone, the recording. So if at any point, if you have any questions, feel free to reply to that email and we'll get to get all the questions to Charlie. And again, thank you, Charlie, for taking the time today.
You're welcome. Thank you very much. You guys do an incredible job. We appreciate the relationship, and everyone have a wonderful holiday season.
Thank you. Thanks, you too.